Show Personal Finance.
Warren Ingram from Galileo Capital in studio this evening. Here is the question, and I'll let you have a look at it because I got an email from a listener, Warren Ingram, and the listener says, my mom has recently made 1.2 million rand from the sale of a property. She's 60 years old, deregistered for tax. She doesn't owe the bank any money. She did buy a new Land Rover recently and still owes 700,000. So I'm sorry, she owes the bank 700,000, but okay, I get your point. It's not on property. She wants to add the money to her retirement savings, but she doesn't know where to put it in order to get the best growth. Should she pay off the Land Rover or invest it? And if so, where is it best for someone at her age with the fewest tax implications? Now, there's a multifaceted problem for you, Mr. Ingram.
Yes, there are so many points to cover here. So, I mean, my very first one, I think, has to be, what is a 60-year-old who's deregistered for tax? In other words, if she's deregistered for tax, she's not generating an income from working. I didn't see it in the question that she's working. So I'm going to assume that she's retired. But what is she doing buying a 700,000 Rand vehicle on debt?
She's retired and she wants to jaw. I don't know. So don't criticize.
No. Hang on. I mean, this is the game. You know, this is the deal. If you put yourself out there, you've got to take it good and bad.
Okay, good.
I mean, isn't that fair?
That's the deal.
So I'm going to say that's actually terrible. That's really not a good idea. It's not. It's all good and well to drive a nice car, but you need to be able to afford it. And if you've borrowed 700,000 Rand to buy a car, and you deregister for tax, then I can't see how you can afford the car, in all honesty. So I think we have to hit that one first. I wouldn't sleep well tonight if we didn't at least say something about that. Then just moving on to a couple of the options, because one of the things is about being tax efficient. And so at 60, it doesn't make a tremendous amount of sense to, for example, to contribute the money to a retirement annuity or retirement fund. Because, normally that would be your almost your no-brainer, tax efficient way of building up your savings. You put it in there, you get a very nice tax deduction, all the growth inside that retirement fund doesn't attract income tax, dividends tax, capital gains tax, or tax on rent. So, but at 60, then you're already at the point of retirement when you would then take money out of it, and so there's no time for that growth to happen tax free. So that's not a starter for her. That means she needs to look at other investments. The next kind of no-brainer one normally would be the tax-free savings account, and I certainly think that's something that she can consider, but she can only put in 30,000 Rand a year.
A year, yeah.
So it's worth doing it because at least the growth that you're going to get on that money will accumulate tax-free, and that's nice. It's not going to solve the 1.2 million Rands worth of capital allocation, but I think she should do that. And more to the point, I would look at investing in a tax-free savings account that has an allocation to listed property as the underlying investment. I love listed property for tax-free savings because normally when you buy either a property unit trust or a property share or a property exchange traded fund, you would pay tax on the income that comes from that property investment because it's actually rent. But when you put it into a tax-free saving, completely tax-free.
Sneaky. Right, good. Nice tip.
There should be some good capital growth over time as well, but it's important to note that those things are volatile. So she's going to see some good ups and downs out of that investment. Then, and my view would be that she allocates money to that every year. And get the 30,000 going into that. So then we've got her other options, and her other options with the balance of the money would be typically either share portfolio of exchange traded funds, or some unit trusts. And I think if she doesn't have the time, the inclination, or the will, frankly, to go into doing shares and actually do the research properly, etc., then I think that's maybe not a non-starter for her in this situation. We don't have a lot of information, so we're really flying blind here a little bit on. So I'm not saying that his mom's doesn't know what she's doing. I'm just we
don't know.
We have to start somewhere. So to me, it comes down to then either exchange traded funds or unit trusts, and I think it's no secret that I love exchange traded funds. I love index investing, but in this instance, where she might also need to generate some income as well, then I would more likely look at the unit trust world than at the exchange traded fund world, and simply here because it's something that can be managed for her and give her the growth that she needs, as well as manage some kind of tax efficiency, which I'll come to, because I think that's an important point here. Very often for someone who's 60, people would be tempted to say, well, that's, kind of retirement age, you mustn't take any risk and, be really conservative with the money. And I think it's always good to be risk aware when you make a long-term investment decision. But the likelihood is that if she's 60 and she has access to capital and financial means, the likelihood is she'll probably live for another 20 years. That's what the actuaries would say, which means that you can't put all the money in a bank account or into something that's going to take no risk and therefore probably won't beat inflation. So to me, with the largest proportion of this money, things like fixed deposits and notice accounts are out. We can't do that and hope to beat inflation. Especially, and that was one of the points which I like, is because we want to be tax efficient. Yeah. So if we want to be tax efficient, that means we want to get capital growth, because you'd rather pay tax on capital gains, which is much lower than paying tax on income. And you would rather earn dividend income, which is already only going to attract you a tax rate of 15%, and it'll be deducted before you even earn the money, so that makes it a bit more efficient. So you would want to earn dividends and get capital growth. And if you want capital growth, that means you're looking at shares, and potentially, again, you might want some listed property here, even though that will generate some taxable income. Because I think, to me, I would be looking, if we're talking about sort of unit trust jargon, I would be looking for typically balanced funds.
Okay. All right. I mean, well, you've given a whole plethora of options and opportunities here for our correspondent's 60-year-old mum. The 1.2 million rand that she's made from the sale of her property, she's got this debt of 700,000 rand on her Land Rover. Should she just go and give the Land Rover back and take a loss on the vehicle that she's just bought? Or should she take money and pay it off in total and then invest the rest?
So the first thing I would do is find out what the resale value of the car is. If it's we don't know how old it just says recently, and I assume if she's I'd really hope that she bought it second hand, but if she didn't and she bought it brand new, then she's going to take a bath on that car if she sells it straight away. So that's the first point. The second point is we would need to know what the interest rate is on that car. I would assume that it's going to be really close to sort of 9 to 10%, which is, it seems to me, where cars are being financed now, unless the manufacturer is giving you massive subsidies on your finance charges, and they do that from time to time. But if your interest rate is sort of that 9 or 10% rate, and we look at what's going on in the world, I don't think we're in a space where stock markets are really cheap. I think stock markets are still kind of, at best fair price, but probably slightly overpriced, which means that we would expect over the next 3 or 4 years that you're probably not going to, be fairly certain of getting 10% a year from shares. And that means pay off the debt.
Pay off the debt. Right. I hope that helps.
Pay back the money.
Pay back the money. Pay it off. And please be careful when it comes to buying cars, especially when you're retired. And maybe she's got a big pile of cash and this 1.2 million rand is petty change. We don't know.
And
last point on this one, because there are lots of people who want to talk to you.
Oh, okay. I'm sorry. So the reason why I don't think there's major other money around is because she's deregistered for tax, and that wouldn't be the case if she was sitting on a pile of money that was generating her rent or interest, etc.
Inspector Clouseau Ingram.
So she might have to register for tax now as well.
She may very well have to. June in Newlands. She's incredibly patient as June in Newlands.
Have been, indeed.
Tell us your story, June.
Listen, I was widowed 4 months ago, and I've inherited everything.
Right.
Okay. The house, which is valued at 4.5 million. Now, I met with someone today who suggested that I put the house into a trust fund.
Okay. Do you have children, June?
Married and with families of their own.
Okay. All right, June. So should the house of 4.5 million rand, Warren Ingram, June's house in Newlands, which she's inherited, should that go into a trust?
Is June still on the line?
June's still here. June's still here.
I'm here.
June, June, I'm really sorry for your loss.
No, thank you very much.
I'm not going to ask you to give me specifics, but are you over 60?
Yes, I am.
Okay. So the reason for that question is putting a property into a trust is going to incur quite a lot of costs, because you, in effect, what you're doing is you're going to sell that house to another.
I don't want to sell it.
Yeah, but just from a transaction point of view,
okay.
What's going to happen from a legal point of view is that you're going to sell the house to a trust. So the trust is a totally different person from you. And that means that you're going to have transaction costs now, because you're going to have to pay transfer duties, and so there'll be some associated legal costs with that as well.
Sure.
And
I understand that.
And the reason that someone would put a house into a trust is you're saying to yourself, I want this property to go to my children and potentially my grandchildren one day, and I want to do that as tax efficiently as possible, which means I don't want my estate to be levied with estate.
Sorry
duty.
about the dog noise.
It's okay. They don't know what we're talking about. That really works well when you've got an asset that's going to grow over a long period of time. It's going to give you a lot of capital growth, and you would put the value in early and let that capital growth go. In your instance, if you're over 60, and particularly if you're quite far past 60, then you don't have 30 or 40 years to allow this property to grow.
I'm 64.
Okay, so the issue here is that you don't have a lot of time on your side to let the capital appreciation really work for you.
Yes.
A trust is a really long-term thing, and your children are already adults, which means you're not worried about having to protect them. If they're 13 or 12 or something, and they need to be financially looked after, they can hopefully make smart decisions. So I think on the face of it, I can't see a great reason to do this. To me, it doesn't make sense.
What, to put it into a trust?
To put it into a trust. You get a capital gains tax benefit when you own a house, your own home in your own name.
It's not in my name. That's the thing. It's got to be transferred into my name. It was in my late husband's name.
Okay, but that's okay, because there's no estate duty when the house goes from the husband to you.
Oh, okay.
That won't be an issue, but it will have a problem if it goes into the trust now. So I don't. On the face of it, to me, it doesn't make sense. I wouldn't do it.
Okay, June, thank you very much. I mean, that's a comprehensive answer there, Warren Ingram. Thank you. Elise in Roodepoort. Elise is gone. She's invested in Nedbank's retail step-up linked to prime rate starting at 7.35%. This sounds like a fixed deposit that Elise in Roodepoort has got. You're not a fan of these fixed deposits, are you?
I like cash when it's part of your emergency fund. So if you should have somewhere between 3 to 6 months worth of your normal expenses. So if you spend 10 grand a month, you need 30 to 60,000 rand sitting in an accessible cash account that's there for the really, the real unplanned expenses. This is not, holiday money, etc., etc. This is for the things that you just can't foresee, and you don't have to go and use your credit card. So that's when I do like a cash account. I would prefer if someone had a mortgage and it was an access bond kind of thing, that they could house their emergency fund in their access bond, but if it's a long-term deal and it's part of your overall portfolio and you really want something to generate capital growth, then a fixed deposit isn't your best bet.
Okay, Elise, I'm sorry we didn't get to you quicker. Elise has left the line. I have 3 properties which I'm renting out, says somebody else. Can I open a tax-free savings account and have the rent deposit in there to avoid tax on 30,000 rand per year? Nice try, I think, Warren, but no. The money you earn from your property is income. The tax-free part of it is just the return you get on the capital you invest, right?
So you can take the rent that you earn and you will have paid tax on that rent. Once you've paid tax, you can then take the proceeds of that net tax amount, put it into a tax-free savings going forward, and everything that you put into that tax-free savings in future will be completely free of tax. Capital gains tax, dividends, etc.
But any rent you get is part of your income and has to be declared as part of your income.
Yeah, other than obviously if it's a tax-free savings account that owns a listed property. It's not possible to own a physical property, unfortunately. Tax-free saving.
Sharon says, I'm an MTN Zakele shareholder. When the deal comes to an end, should I reinvest in the new MTN Zakele Futhi scheme and be locked in for an additional 8 years? Or would it be better just to choose ordinary MTN shares and receive dividends, which will not be paid in the new scheme? Because those dividends, of course, subsidize the lower price you pay to get in to MTN Zakele Futhi. Warren, any thoughts on that?
You're asking the ETF guy about a share.
No, it's the question.
I'm sorry. I'm going to have to say, and I hate sitting on the fence, but I really don't know. I have to say I don't know, and I don't know on this one. I normally pass this off to the portfolio manager people.
Okay. No, absolutely right. Okay, Warren Ingram, I'm going to let you go.
Oh.
I'm going to let you go. You've been wonderful.
Fantastic.
Because guess who's given us a call?
Orange
I told
peel.
you. The orange peel lady, but not the girl herself, unfortunately. She's still coming through customs. But Warren Ingram from Galileo Capital, financial advisor, thank you.